Welcome to another Video Campus Explainer video. In this video, we will be discussing the tax and accounting advantages you can enjoy when you invest in Video Campus content. We will be discussing the 3 ways Video Campus content prevents tax losses while increasing the likelihood of additional revenue. And if that is not enough incentive, our content additionally acts as an asset that can be capitalized. We will discuss the 3 main financial advantages that combine to give you exclusive benefits you can't get from making your own internal videos or social media posts. These financial advantages, when added together, explain the financial incentives the government provides to you to invest in video content that promotes and grows your business. That means the government has drafted rules and accounting standards that incentivize you to invest in promoting your business rather than pay money in taxes. Yes, you heard that right. The government has set the table in such a way as to give you yet another, perfectly legal opportunity to lower your income taxes. To put it another way, if you pay income taxes at the end of the year, you have made a series of problematic executive decisions. You have chosen to miss out on opportunities available to you to not only reduce your tax burden, but to transform the money you would have lost in taxes into an intangible asset that remains on your balance sheet. And as we will demonstrate, you are allowed to capitalize the value of an intangible asset as collateral for a line of credit. This means that when you invest in Video Campus content, you don't lose a single penny in the process. Instead, you have just transformed your taxable income into a retained business asset that promotes your business, generates goodwill, and builds brand advocacy, as well as helping you encourage referrals. This adds up to a net positive executive business decision for you to make. And if this video does not prove the point, then be sure to follow the link in the description box below. There, you will find an article published by the online journal called ProRepublica, titled "The Secret IRS Files Trove of Never-Before-Seen Records Reveal How the Wealthiest Avoid Income Taxes." There, you will read about leaked IRS documents that prove beyond a doubt that the so-called rich people don't pay income taxes, but the ironic takeaway from this article is that the government provides these tax incentives to everyone, and it's not illegal. And believe it or not, it's not immoral because of the fact that fractional reserve banking allows them to print money out of thin air by just typing numbers into a keyboard. That means you just have to think and make decisions like a rich person, or just like their highly paid tax advisors. So, let's get to it and see how the laws and rules work in your favor if you know how to take advantage of them. In this video, we will explain how Video Campus content provides these 3 following financial advantages. They are: Number 1, a tax deduction. Number 2, an intangible asset. Number 3, an inflation hedge. Let's look at each one in greater detail. Number 1, as a tax deduction. This one is at first glance obvious. When you make a business purchase, you can claim it as a 1099 deductible expense. But did you know there is a difference between expenses? Some expenses that help promote your business, such as advertising and customer entertainment, are consumable expenses. That means they are not allowed to be recognized as a business asset. They are just a consumable expense. Once the cash is spent, the benefit is consumed. The cash cannot be spent again to accomplish the same promotional task. But as we will see in number 2, Video Campus content is different. It is not consumed. You can use it over and over again. That's right. It is like spending your cash over and over again on advertising or entertainment indefinitely into the future, along with the government's blessing. In accord with International Accounting Standards 38, the purchase of a promotional video from an external vendor qualifies and is recognized as an intangible asset. That means the value of the asset remains on your balance sheet. The cash is not consumed, but rather the cash is transformed into an asset. But not just any asset, it becomes part of an automated machine that helps you enjoy future financial benefits, resulting in future revenue inflows. So let's scrutinize the proof, so you can see for yourself why Video Campus content is recognized by international accounting standards as an intangible asset. There are 5 criteria that must be met for a purchase to qualify as an intangible asset. We will first list these 5 criteria and then discuss them in more detail. To qualify according to accounting standards, an asset must be: Number 1, separable and distinguishable. Number 2, the business entity must control its rights and property, being a conveyance of rights by contract or by deed. Number 3, the business entity controls the future economic benefits flowing from its use. Number 4, Its value is measured reliably at cost as its purchase price as an expense. Number 5. The asset must have a defined carrying cost as its determined value during its useful life. So first, let's take a look at the criteria concerning separability. The price a business entity pays to acquire an intangible asset will reflect expectations about the probability that the expected future economic benefits embodied in the asset will flow to the entity. The cost of generating an intangible asset internally cannot be distinguished from the cost of maintaining or enhancing the entity's internally generated goodwill of running day-to-day operations. That means that an internally created video does not qualify as an intangible asset. That also means that every homemade video, including an employee-made video or social media post, which includes selfies, whatever the cost, cannot be claimed as an intangible asset, because the cost of its creation cannot be separated or distinguished from day-to-day operations. Ironically, this is even true for Video Campus as a business. We cannot even claim our own videos as an intangible asset because of the separability clause. Second, let's take a look at the control criteria, which includes the legal rights criteria. In order for a business to demonstrate control, the business entity must have legal rights conveyed to it from an external entity as the principal owner of the intellectual property rights. These rights are conveyed under contract or deed. Only to the extent a legal entity can demonstrate the acquisition and holding of a legal right by contractual conveyance can a business demonstrate meeting the criteria for control. The receipt of purchase, plus the contract in terms of service, is proof of the conveyance and control of a legal right. Third, let's look at the control of future economic benefit criteria. The aspect of control is a business's ability to demonstrate it will be the beneficiary of the financial inflow derived from the use of the asset. Video Campus fulfills this criteria for the entity by custom branding every video with the business entity's logo, images, and contact information, as well as the call to action, like asking for referrals, which demonstrates the probability of future economic benefit derived from the use of the asset. Fourth, now we will consider the value of the asset. In order to meet the criteria of value, the asset must have a clearly defined cost as its purchase price. This is similar but different from separability. In order for a business to determine a clear and definable cost of the asset, the cost of its creation must be separate from normal day-to-day business operations. This is most easily accomplished by simply purchasing the asset from an external vendor for a purchase price. That means the invoice sets the par value of the asset against the number of dollars used to purchase the asset. It is presumed the value of the asset is determined by the purchaser because of the probable net gain in future revenue, making it a viable business acquisition. If an entity could not be convinced of the possibility of future economic benefit, that asset would not be purchased because it does not contain any perceived value. That is why its value can easily be pegged to its purchase price, making price the lead indicator of the asset's value in the marketplace. Fifth and lastly, let's look at the carrying amount. The carrying amount can be influenced by either amortizable depreciation or the manager's ability or inability and unwillingness to properly use and deploy the asset to enjoy the financial benefits from its use. Otherwise, the carry amount will remain constant and indefinite, not subject to amortization. As long as it is used and managed properly, the entity will derive the monetary benefit from its use and deployment, being new revenue inflows in this case, resulting from referrals being those who buy the entity's services. Now on to number 3, the inflation hedge. There are 5 main components that prove investing in Video Campus content is an inflation hedge. All 5 of these components must be met to qualify as an inflation hedge. Number 1. Taxable income must be transformed into a legal business expense to prevent the losses associated with tax liability. Number 2. Cash must be transformed into an intangible asset, that in this case is a promotional video. Number 3. The purchase price determines the value of the asset as its purchase price. Number 4. The purchase price is locked to the dollar as its par value. Number 5. The video must promote your business and bring in new revenue at inflated prices using US dollars adjusted for inflation. Now we will explain each of these criteria in greater detail. First, your business needs to take advantage of every opportunity to prevent tax losses. Taxes are the first and primary liability that is corrosive to your net worth. Second, as we have discussed previously, a promotional video bought from an external vendor qualifies as an intangible asset. That is a fact of law. That means you are transforming your taxable cash into a retained intangible asset that remains on your books. You lose nothing in this transaction. Third, you must have a receipt that sets the par value of the asset at cost against the dollar, being the price you paid to purchase the asset. Fourth, since you used US dollars to purchase the asset is now also subject to the corrosive effects of inflation, because its value remains constantly pegged to the purchase price. However, we are not yet done engineering a tax-deductible inflation hedge. We need one more component to make this work. Let's look at number 5 and bring it all together. Now the video canvas content needs to go to work and get published to your social media platforms and also through your email list. Now the video content will do its job to automatically ask for referrals, encourage brand advocacy and goodwill, and help you remain top of mind, which referrals depend upon long after the sale. When you acquire a referral that results in revenue from a sale, you have earned new, inflated US dollars. By earning new revenue that is adjusted with inflation, you have now enjoyed the benefits of a hedge on inflation. Because the only sure way to hedge against inflation is to generate new and current revenue pegged to the value of inflated US dollars. So, there you have it. 3 sensible reasons to invest in video canvas content. We apologize for the technical jargon used in this video, but there is a need for clarity to understand why some people make use of the tax laws and accounting rules, and others do not. Taxes and accounting can be a scary subject for some, but there is no reason every business cannot enjoy the full benefit of the laws intended to be used in your favor. It is simply a matter of learning about the perfectly legal and down-to-earth options available to you. So to conclude, let's briefly review the lessons learned in this video. We discovered that there are 3 primary benefits to purchasing video canvas content that results in preventing tax losses and gaining the possibility of earning new revenue. These 3 financial advantages are: number 1, video canvas content is a tax deduction. Number 2, video canvas content converts taxable income into an intangible asset. Number 3, the probability of new revenue from these videos acts as an inflation hedge. As a result, deciding to invest in video canvas content is a net positive gain for your business. So with that in mind, can you think of a good reason or objection that nullifies or refutes these reasons? If you can, we would love to hear from you. Just send us an email describing your thoughts and concerns, and we will be happy to get back to you. Otherwise, let us know what is holding you back. There is a link in the description that will take you to the menu page so you can see pricing and options. If you need to know more, and you would like to see how these videos are designed to help you encourage referrals, please watch the next video in this series at the end of this video. Please follow the links in the description box below for additional information, or go to videocanvas.com to learn more. If you received this video as a result of our outreach, please feel free to reply to any other question you may have. We will get back to you. Thank you for watching.